Hello everyone. In this session, I'm going to talk about how do we decipher the liquidity and the credit crunch that occurred during 2007 and 2008. This is purely based on the article that is written by Marcus Brunner-Meyer. So we are going to have a summary of this article where a few things I want to look at, starting with the key factors that are leading to the housing bubble. What are the key factors which contributed to the housing bubble? There was a lot of liquidity squeeze during that 2007-2008. So, what were the banking industry related trends during that period? What were the things that were observed in the banking industry during that period? Whichever has contributed to the liquidity squeeze. And based on this, we will look at whatever the liquidity crisis that has occurred during that period. What are the key triggers? Is it the housing bubble? That's the key trigger. Or along with it, there are few more other aspects which contributed to the liquidity crisis. We are going to have a look at that. Then, in this context, we are going to talk about few interesting concepts that became very popular during that period. One being the collateralized debt obligations, in short called as CDOs, that are created by the banks. So we will try to understand some of their properties and how they could have really played a role in terms of the crisis. Similarly, we also will look at credit default swap, another instrument that became very popular during that period, and in what way even the credit default swaps have typically contributed to this liquidity squeeze. We will have a look at that. Then, understanding the various structured and securitized products. Yes, CDO is one of them. CDS is one of them. So all these structured and securitized products, how did the investors actually use them? Who are the main investors in these products? And how these products have again led to the crisis because of their increased usage. How were investors using them and what had actually resulted when the usage has gone up drastically. Now that we are talking about the article on liquidity, we should differentiate between what is a funding liquidity versus what is a market liquidity. So let's get some kind of a hold on the conceptual aspects between the same. And how does actually evaporation of liquidity can result in financial crisis? Probably we should look at the 2007-8 crisis to try to understand why should a liquidity evaporation result in financial crisis. And finally, we will also bring in how does the increase in the counterparty credit risk contribute to the liquidity crisis, right? So these are the various aspects that we are bringing in. So our focus here is more in terms of the liquidity crisis that cropped up during the 2007-8 time frame. So some of the aspects we already know. If you talk about the key factors that were leading to the housing bubble, during that time frame, the interest rates in United States were much lower, and because of various reasons. One, there was a large capital inflow from abroad. So huge capital was flowing into the United States, especially from the Asian countries. So that's one reason. The interest rates were much lower, and even the another thing that came in at that point was the Federal Reserve. It has a lax interest rate policy. So, because at that point itself, during the early 2000s, we had the dot-com bubble, internet bubble, and the Fed has actually feared that after this, there could be a possibility of a heavy deflationary period, and because of which the economic activity could go down quite drastically, and that could be one of the reasons why the interest rates were kept much lower. It has followed a lax interest rate policy. So these are the two important reasons why the interest rates were much lower during that period. Now, why did more and more capital inflows came into US from the Asian countries? One, they wanted to peg their exchange rates so that the exports are not impacted badly. So majority of the investments came in with that kind of an objective. They want to peg their interest rates so that everything is export friendly. And there is a fear that their own currencies are they have a good risk of depreciation. So they want to protect themselves against this risk of depreciation of their own currencies against the dollar. So they found that investing in the United States is a much viable option. So that is at that point where the whole banking system in the United States is going through a major transformation. Early 2000, there are huge modifications, or probably you call innovations, that have come up in the banking system. So there are lots and lots of changes that are coming into the US banking system. So there is no more traditional model. Traditional model is getting faded off. Where we are talking of, when I say traditional model, lending and deposits and loans. Deposits from the customers and giving loans and keeping the loans, servicing the loans. So this is the kind of a traditional model of a bank. Now it is replaced with originate and distribute model. So the banks are no more keeping the loans. They have given the loans, they have pooled them, they have tranched them where they have bifurcated the same and then resold. So that is where we are calling as originate to distribute. The loan has been originated not with an intention to serve it until the maturity, or not with an intention to collect the proceeds up to maturity, but they have packaged all those loans and into different financial instruments and resold them to the investors, got cash immediately and used that cash for additional loan. So this is a scenario where the loans are additional loans are issued quite faster, because the existing loans are packaged and sold to third parties and to the investors for fetching fresh capital. So that model came into picture. So it's no more a traditional banking model. It has got transformed into an originate and distribute kind of a model. So all these things really started the initiation process for the crisis. The financial innovation, which is that originate and distribute kind of a model, resulted in unexpected credit expansion. Because see, in the normal model, I have given a loan, right? I have given different kinds of loans. People pay interests and principals at regular intervals of time. So only a portion of the interest and principal come every year to the bank. Now with this they could think of issuing fresh loans. But in the originate and distribute model, this entire loan is sold to a third party or is repackaged as various financial instruments and is given to the investors. Now the investors are again investing back the full money, buying all these securities. They have given again the full money within no time into the banking system. So because of that, again that money is available with the banks to give fresh loans. And all this has resulted in an expansion of the credit world altogether. And this was not expected to this extent. And because of that, the housing prices started booming because more and more loans are available. So because more loans are available, the housing prices also started going up. The real estate market was also showing different signs of boom. And when the housing market is going up, the housing prices are going up. Even in the lending standards, the basic quality was not maintained by the lenders under the simple premise that the housing prices are going up and that house can act as a collateral. And under that assumption that that house or a property can act as a collateral, no one bothered to really evaluate the capacity of the borrowers. So no kind of quality verification has been done with respect to the borrowers. So that is one major place where the whole housing bubble started bursting. And looking at the borrower's balance sheet, the whole borrower's balance sheet has got affected. Two liquidity spirals came up altogether. If you look at it in depth, now when the asset prices drop, let's say the real estate prices are dropping and when the other prices are falling, the capital with the financial institutions is eroding. Because their prices have dropped, the value of their assets has gone down, and because of that their capital got eroded. And at the same time you see the lending standards are getting tightened both the ways. The loans are becoming very strict and their capital is also getting eroded quite drastically because the asset values have fallen. So the asset values have fallen, the lending standards became tight, and this way for all the customers there were fire sale. So they were not able to recover the interest and the principals, and new loans they were not able to give, and because of that there is entire fire sales. Quickly I have to sell off my assets, and obviously when I sell my assets now, because on the assets I'm not able to raise any kind of fund, new loans are not getting raised, so the existing assets have to be sold off at much compromised prices. I cannot sell off my asset at the real market price. So once it's a compromised price, even the prices of the assets have gone down drastically. The funding got even more tightened. So this is one of the major reasons for the bursting of the bubble. Lending channels are completely dried up. The reason being, at that point banks are very concerned about their future access to the capital market. Can we raise capital in the future? Can we get more funds in the future? They started apprehending. Now once that apprehension comes up, they did not get into the lending process. So the loans got completely tightened and there is a complete dry up of the loans. Because they were very much worried about their future access to the capital markets. And at that point we have seen there were so many runs on the financial institutions. There was a very important necessity for liquidity in the banking system at that point. Lot of people were withdrawing the funds which they have deposited with the banks. So there were huge runs on the financial systems, financial institutions like Bear Stearns, Wherever people have invested their funds, they wanted to pull them out. Lehman Brothers, Washington Mutual. So all these have really contributed to a sudden erosion of the capital. Now, this entire thing even occurred because of the network effect. Because you could see that in many cases, majority of these big financial institutions, they are lenders for some kind of transactions, they are borrowers for some kind of transaction. So you could find different kinds of lending and borrowing agreements that are there in place between or among the various financial institutions itself. And also at the same time, they have got into quite a few derivative contracts, out of the over the counter derivative contracts, where they were the counterparties themselves to the different trades. So because of that also, when one of the banks have defaulted, there was a kind of a chain reaction, a ripple effect across all the banks, which have resulted in the failure of the entire system per se. So the multiple trading parties failed to cancel out all the offsetting positions because they were very concerned about the credit risk of the counterparties. Now all these things have really contributed seriously to the housing bubble. Then what were the indications or the trends that you are able to see in the banking industry which have really contributed to the squeezing of liquidity? So one thing we have already talked about, the originate and distribute model. So the banks, they are now no more holding the loans on their accounts. So their balance sheet, they wanted to reduce the size of their balance sheet by removing the loans or moving the loans from their balance sheet altogether. So they moved to originate and distribute model. No more traditional banking is there in place. So when the originate and distribute, as I have already talked of, all the loans that they have given, there is a packaging of all the loans. So this is the base, this is the total asset base. Against this asset base as a collateral, they have issued various securities to the investors. So various investors invested in these securities, which means the funds again came back to the bank. So from the bank's perspective, the risk is completely offloaded. And so which means all their assets, whichever are there, if you see all these are all long-term loans, right? So the loans that they have given are long-term, but the investment that they have got are majorly short-term. So their entire long-term asset holding is again funded with short-term maturity instrument. That's almost always the case with the banking sector. Even if you talk about the deposits are used to fund the loans. So the deposits are majorly short-term, loans are majorly long-term. So the deposits are always used to fund the loan. So there itself there are liquidity concerns, right? But in an economy where the economy is not moving in the right direction, this could have serious repercussions on the banking system. Even in this process, the same thing has occurred. All their long-term asset holdings are replaced with short-term maturity kind of instruments, and that's the reason the whole dry up in the funding liquidity has occurred during that crisis. So if I have to list out the major triggers for the liquidity crisis during that period, one, there were a lot of loans that were given subprime. Means even the basic quality check of the customer is not performed before the issuance of the loan. So they were all subprime loans, and we have seen that during that period there were heavy number of defaults on those loans. And even the banks or any financial institutions, they were not able to get themselves insured against all these basket of mortgages also, right? Because the cost of getting insured against all these defaults was increasing exponentially, because the risk of default has increased. So any kind of an insurance against an increased risk would obviously result in an increased premium, which means the overall cost of transferring or getting transferring the risk has increased quite drastically. And the various instruments that were innovated during that period, we were talking about repackaging of the loans and being sold. One of the major instruments that was created during this repackaging process was the CDO, which is the collateralized debt obligations. Even those CDOs, earlier they had very good credit ratings. Some tranches of CDOs received AAA credit rating. So what you could see is, now once the subprime mortgage defaults have occurred and the banks were not able to insure themselves against the risk of default, even the various instruments that were issued with that loans as the asset base, their tranches, which were at one point having very high credit rating, even they were getting downgraded. Now, which means their prices are actually falling quite drastically. Of all those products, their market value started falling quite drastically. And during that time, even the hedge funds, which have placed heavy trades on these CDOs, they also got off track. So they were heavily meeting margin calls, and they were heavily getting margin calls, and they were not able to meet those margin calls at all. Even various short-term financial instruments which were supposed to be highly liquid, like asset-backed commercial paper, ABCP, or even the repos, which hardly had any kind of chance of default, even for those kind of highly liquid instruments, the market completely dried up. And this is one of the prime reasons where big funds like Lehman Brothers have really had to collapse. And another way of looking at it, during that point, the TED spread. What is this TED? I'm talking about the difference between the LIBOR, which is supposed to be an interbank borrowing and lending rate, versus the T-bill rate, which is more like a risk-free lending or borrowing rate. In normal cases, we don't see a big difference between these two rates, because if you remember, LIBOR is used as a proxy for risk-free rate by the derivative traders. So, which is more an indication that LIBOR is also a kind of closely equivalent to a risk-free rate. So, as long as the economy is doing good, this difference between these two is almost negligible. But what you find is, when the economy is going through tough phases, going through a crisis situation, we see that this spread is going to be much higher. So by looking at the TED spread, you could really gauge the severity of the crisis, and which we have seen during the crisis, this percentage was abnormally higher. So overall, if I have to talk about the trigger for the entire crisis, one, there were very high number of mortgage delinquencies, lots and lots of people defaulting on their mortgages, because of the entire country level decrease in the prices of the real estate, and that entire thing really created a ripple effect in the entire financial system, thanks to the various financial innovations that have come during that particular period, which could not be utilized properly, and the net result is a fully blown liquidity crisis. Got it? Now, let's try to understand some of these products that were created during the time frame, which was more from a transition from a traditional banking world to an originate and distribute kind of a world. Now, as I've already talked of, I'll just describe it here. Now, we have different kinds of mortgages that the banks have given. Let me call it M1, M2, M3, M4. Four different kinds of mortgages have been given by the bank. Now, we are pooling all those things, and based on that, so it need not be only mortgages. I could take the other types of loans like student loans, vehicle loans, etc., or even the various corporate bonds, or even the other assets like credit card receivable. Now, let's say these are the various portfolios of mortgages. I have pooled the amount of entire thing. Let me take some numbers. Let's say this is 100 million, this is 200 million, this is 300 million, this is 400 million. So overall here it is 1000 million, right? So this is the total worth of this portfolio. Now, so the asset base for this portfolio is the 1000 million. Now what I do, I'll slice these portfolios into different tranches. So this, out of this 1000, I'll create something like this. Let's say some 750 million, I'll put it here. Some 200 or 150 million or 200 million, I'll put it here. And the remaining 100 million, or probably let me say 200 million here, and probably 50 million here. So this is how I am spreading this. So which means I am creating three different instruments out of this entire pool of mortgages. Now, this I will call it as a senior tranche. This will be a mezzanine tranche, and this would be an equity tranche, or probably the junior tranche. Now, so senior tranche will typically get a very good credit rating, let's say a AAA credit rating. Mezzanine tranche somewhere in the middle, let's say BB or a BBB kind of a credit rating. And the equity or a junior tranche may not get anything. So the intention here is I am creating three different kinds of instruments. So this would be sold to one set of investors. They have a very low risk appetite. This would be sold to another set of investors who have moderate risk appetite. And this may or may not be sold to any of the investors. They can be very well maintained by the issuing bank itself. So this may not be sold at all. Now, the way it works is, when these people, right, whosoever are the borrowers, they start paying the interest as well as the principal on their loans, this money gets into the pool out here, and now this set of people will be first paid off. The interest and the principal part will be first paid to the senior tranche. Then any more money coming from here, that would be used to pay off the mezzanine tranche, and further any more funds are coming up, they are used to pay the equity tranche. So that's how the payments are going to occur. So the first payments that are coming from the interest and the principal repayments would be used to pay the senior tranche, then the mezzanine tranche, and then the subordinate or equity kind of a tranche. Now the process here is, if there are some kind of defaults that are occurring, right? If some people in this group, they fail to pay the interest and the principal, this set may not get affected because this is worth 750 million, which is approximately 3/4. So only if less than 3/4 of the people make the payment, then only this group will be troubled. But as long as more than 75% of the people are typically paying their interest and principals on time, this group will be receiving the payments on time, followed by this group, which means this group will absorb more number of losses. That's the equity tranche. So any kind of defaults that are coming from here would be first absorbed by the equity tranche. And after the entire equity tranche has absorbed the loss, then comes the mezzanine tranche, and after the entire mezzanine tranche has absorbed the loss, then comes the senior tranche. So that's the reason the senior tranche is typically regarded as a very less risky kind of an instrument, which in turn receives a triple A kind of a credit rating altogether. So that's how the whole collateralized debt obligations have been created. If you look at the word, there are debt obligations. The debt obligations could be mortgages, any other kind of loans, bonds, credit card receivables. They are all the various debt obligations. By creating first by creating the pools out of them, and splitting these pools into various tranches, identifying the various investor groups, and then trying to sell these various tranches to the different investor groups with different levels of risk, is what is the entire process of securitization. So you could see that the senior tranche is the most safest tranche, and because it is getting a high credit rating, low risk, even the returns would be much lower, but they would be the one that are first paid based on the interest and the principal payments that come out from the borrowers. So their credit ratings are the best. Mezzanine tranche is always between the equity tranche and the senior tranche. Equity tranche is the junior most kind of a tranche. Only after all other tranches have been paid, the payment will occur to the equity tranche. And generally, the equity tranche would be held by the issuing bank itself rather than selling to any of the investors. So that is how the collateralized debt obligations typically work. And as long as they are used in a normal way, we see them as risk mitigating instruments, and at the same time we see that the banks are able to get much more benefit by going with these, because they were able to get cash much faster, which resulted in they giving more and more loans, and it resulted in a very drastical expansion of the entire banking system as well. So this concept at this level, if I am looking at it, looks that there are more positives rather than any kind of negatives. It looks like a very serious financial innovation that has come up, which has revolutionized the entire banking model per se. Right? Now, once this clarification of CDO is there, the other instrument that I want to cover in this context, which also played a very important role during the liquidity crisis, is the credit default swap. Now, we said people have invested in the tranches, in the CDO. Or let's say they have invested in regular bonds that were issued by various organizations during that period. Now, one way they could have protected themselves, or they have actually protected themselves, is by purchasing a credit default swap. So it's like this. A is the lender and B is the borrower, or B is the borrower, lender, or probably you call investor. Now A has a risk that B might default, and to protect themselves against this risk, there is a way that they can approach C, who is a seller of credit default swaps, and A becomes the buyer of the credit default swap or the buyer of the protection, and C is a seller of protection. So basically, this credit default swap is a kind of insurance against the default of B, who is a borrower, or by creating a bond, who has borrowed through a bond, or who has sold some kind of a tranche of any of the CDO. So these are typically bought by investors. They are protecting themselves by buying the credit default swaps. So in this process, the buyers typically keep paying some kind of periodic premiums, just like an insurer. They keep paying premiums at periodic intervals of time until the default event occurs. And let's say if the event has actually occurred, let's say B has defaulted, then C would be compensating A for the amount that B has to pay. Now that is what we are calling as a credit default swap. There is a kind of a swapping of the roles that is occurring, especially when there is a default that has occurred. In the normal cases, it's just like you pay a premium, the default protection buyer will be paying a premium to the protection seller. If the default does not occur, that's it. No other payment from the default seller, right? Protection seller or the CDS seller. But in case the default occurs, then the protection seller would be compensating the protection buyer for the amount of loss that the buyer is going to incur. So buyer of a AAA rated tranche, right? This person might have bought the AAA rated tranche of a CDO, and along with that, if he has bought a CDS as well, probably the risk of default for him is going to be much lesser. They would really carry a very low amount of risk. So that's the reason during that period, along with the CDOs, even the CDSs became some of the more powerful instruments per se. Then, now looking at these two major structured products, we have seen that the intention of creating different kinds of securitized and structured product is, so a senior tranche was catering to low risk kind of people, the equity tranche was catering to high risk kind of people, and the mezzanine tranche was catering to moderate risk takers. So we have identified investors at different levels of risk. So different products are designed to meet the requirements of the risk levels of different investors. Now the main idea behind securitization is the risk is getting shifted. Now the bank is no more bearing the risk. Right? Bank is getting its risk transferred to those who are really willing to bear the risk. So there is a big risk transfer that has occurred, and along with that there is a spread of the risk also, because it's no more one single entity called a bank which is bearing the risk. It is getting entirely distributed in the entire among the big set of market participants. And because of that, the mortgage rates will fall because the risk, overall risk structured with one single bank has actually come down, and the interest rates are typically getting lower altogether for almost all the kinds of loan. And at the same time, now look at it from the buyer's perspective or the investor's perspective. They are able to hold, or they are able to gain an access to different kinds of assets, right? Now, earlier they might have got prevented from investing in, let's say, the pension funds. If you look at the pension funds, they have to invest only in high rated kind of securities, let's say AAA only. But not all mortgages may not carry a AAA kind of a rating, so they are not eligible to invest in mortgages. But because of this securitization, the pool of mortgages actually got converted into a senior tranche which carried a AAA rating. And because of this reason, now the pension funds could directly invest in the senior tranche of these CDOs. So, in a way, they are able to get the exposure to the mortgage market indirectly, whereas earlier, as per the regulations, they were not able to invest in the mortgage market because of their regulatory requirement. So that way, securitization and the securitized products have really opened up many avenues for the parties to invest in those kinds of assets where they were having a lot of restrictions earlier. Now comes the biggest problem: banks, including various sophisticated investment banks. They were the major buyers of the structured product. So now you see the cycle. Now basically the loans which were raised by the banks, they got converted into structured products and they were issued to the investors. Rather than a different set of investors buying them, it's again the banks who were the investors of them. So actually the risk did not go away from the banks. This is a big concern. Banks which have eliminated the risk here by doing a originate and distribute kind of a model ultimately ended up as the major investors in the structured products that were released out of their own financial, out of their own mortgage based assets and other loan based assets. Now here the reason why they had to get into this process is the regulatory and the rating arbitrage. This was more of treated as the credit process, which means it was lying more and more in their banking book, whereas this is treated as a part of the trading or investment. So the transactions here were lying more in the trading book of the bank. Now this is what is a regulatory arbitrage. Anything that is there in the banking books required a high capital, was considered as more risky because that's the core business of the bank. So high capital was really required by the regulators to for any kind of assets that are there in the banking book, whereas relatively less amount of capital was required as a backup against those assets which are there on the trading books. So virtually this created a kind of an arbitrage, and this is what has been exploited by the banks very heavily. So every loan they tried to move away from their banking book by creating these kind of structured products, and at the same time they have purchased it and converted those assets from banking book to trading book, for which less amount of regulatory capital was required. And overall also all the pool loans, they have they have taken out from their balance sheet, issued structured products, and the pool got a very high credit rating. And because very high credit rating existed, even the regulatory capital requirements have gone low drastically. So if you see the whole process, because of this regulatory and ratings arbitrage existing, every bank had got into the process of exploiting this arbitrage opportunity, converting everything from their banking book into trading book. And a few important points in this context: the statistical models which were used by various investors, credit rating agencies, they were giving very optimistic forecasts regarding all these tranches, CDOs, etc. The mortgages, they were predicting that the default on the mortgages was much lesser, so they were given very high ratings. And the rating was more and more favorable compared to equivalent corporate bonds also. The reason here, again, there is a kind of a discussion regarding the trustworthiness or reliability of the rating agencies. Corresponding to these CDOs and other structured products, they received high amount of fees to rate these products. And it is also understood that because they have charged high amount of fees, there is a good possibility that they have given them much better rating compared to the corporate bond, where they have charged much lesser amount of fee. Even the understanding levels of these products were slightly lesser in among the rating agencies compared to the kind of understanding they had on the various traditional products. So though the innovations were good, though the securitization and the structured products were really useful, but the way they have been used during that 2007-8 period resulted in various misutilizations, causing crisis across. So if there was an increased usage, whenever there was an increased usage, and because every bank was using these products just to raise a loan, create product, sell it off, and invest as investor. Now they were not able to assess the credit quality of the borrowers at all. So cheap credit started coming in. Lending standards have fallen quite drastically, and banks did not bother to really assess the credit worthiness of the borrowers because they were facing only the pipeline risk. Their only job is for some months hold on to these loans, package them, and just pass it on. Hardly a couple of months they were holding these loans on their balance sheet. So why should they really bothered about evaluating the credit worthiness of the borrowers in depth? So they did not take any kind of a care in approving the loans applications or even get into any kind of monitoring process. They have also got into the process of teaser rates, especially the brokers, mortgage brokers. They started offering teaser rates. Okay, first few years the interest rates are very low. The borrowing rates are very low, and after that they'll be on an increase. So attracting by giving these kind of offers on the interest rates during the initial period. So even the documentation, very little or almost no documentation. You don't need to give any kind of a documentation to get a loan. Or in some cases there was even a situation of piggyback mortgages, which is like I'm combining two or more mortgages, so that even that basic minimum down payment that I have to make is getting avoided in the process. I'm looking at the first mortgage is on the main house or the property, and whatever the down payment that I have to make, I'm taking another mortgage to make the down payment. So that way almost the entire down payment process is completely avoided, and even that has been initiated by various mortgage brokers. Even we have ninja kind of loans. It's again a very dangerous thing. No income, so we don't have people working. They don't have a job or any assets. No income, no job or assets kind of loans were also given, and they are all given under one single premise. They did not do any kind of bank background checks in all these kinds of loans, because they were blindly going with the premise that the housing prices, the real estate prices will only be on a rise, they can never fall. So because they can only increase, the property itself could be serving any kind of default, and it can act as a collateral. So that's the kind of a premise they all went with. And after that, we could see once the bubble has bursted, it has a huge impact on the overall economy. Now, in this context, we should understand some of the conceptual terms. In the liquidity world, we use two words: funding liquidity and market liquidity. Funding liquidity, as the word is very clear, what is the comfort I have in terms of raising the funds? All these investors, arbitrageurs, to what extent they can get the funds from the investors. If they are able to get it easily, we say that liquidity is very high. If there is a very big difficulty in terms of raising funds, then we are talking about low levels of liquidity or a liquidity crisis. That is the funding liquidity part. So the liquidity is very high if it is easy to raise money. Now here I want to bring in three major aspects. Now anything that I am buying or selling, generally a margin trade. Margin is I am borrowing from my broker and doing the trade. Right? Now, for any kind of buying or selling through margin, there is a margin or a haircut that is applied. I am keeping some of the securities as the collateral with the broker. So, if I am borrowing, let's say 100, probably the assets worth 110 may have to be kept as a collateral with the broker. If I am borrowing 90, 100 may have to be kept as a collateral with the broker. Now, again, how much of collateral has to be kept? The difference between these two, what is the collateral that I have kept, as well as the price of the security for which I am doing the borrowing. This is typically, or probably whatever I have kept as a collateral versus what is the amount of borrowing that I am doing, or what is the amount of security that I am taking for shorting purpose. This is what is called as a haircut. When the liquidity is good enough, this haircut will be much lesser. But if the haircut is increasing like anything, it's an indication that the funds are very difficult to obtain. So that's the reason huge amount of collateral is being considered, and that itself will lead to a funding liquidity problems at a later point. That's one place. So this is where I summarize. There is a margin or a haircut funding risk where the margins and haircuts will actually increase in future, thus tightening the scope for borrowing in future, the funds availability for the future. Then the second case is whatever the loans that I have taken for a shorter period, that loan could be matured, right? Or probably whatever are the short term sources of capital that I have used, majorly it is commercial papers or repos. These are all short term sources of financing. Now, once the maturity date comes up, the banks and the financial institutions raise a fresh loan, try to pay back this existing loan, which means they are rolling out the process, rolling out the debt over a longer period. Now, if it such happens that this loan, it could not be repaid by raising a fresh loan, means I am not able to roll over the debt, where there is a substantial reliance on the new sources of borrowing. So I'm not able to raise capital through new commercial papers and repo contracts, and because of which I'm not able to pay the existing ones even though they have come to the maturity stage. That is what we are calling as a rollover risk, another problem of funding liquidity risk. It's very costly or impossible to raise a fresh loan to pay back the existing loan. Even that is a form of funding liquidity. The other major form is lots and lots of depositors are running to the banks to withdraw their demand deposits, or any kind of investment that have been made by the investors in various funds are getting withdrawn at much faster rate, which is what we are calling as redemption risk. People want to redeem their investments as early as possible. So with respect to the depositors, they are withdrawing their amounts from the banks, and with respect to investors, they are withdrawing their funds from the investment at much faster pace. Even that is creating a problem with respect to funding liquidity. So all these are aspects where funding liquidity risk is bound to occur. Coming to the next aspect, market liquidity, the word is very clear. Market. I want to sell off my asset and I want to raise money. And if I have a difficulty doing that, then it means there is a market liquidity specific risk. So when I have to sell the asset, I have to compromise on the price. The price of the asset goes down so drastically that I'm not able to sell it at the price that is of interest to me. So overall, if I have to talk about market liquidity, how comfortably I am able to find my counterparty to get onto the other side of the transaction without really having a big compromise on the price. So that is what contributes the market liquidity. Looking at the subforms of the market liquidity, we talk about three of them. One being the bid-ask spread. So to what extent the traders are losing if they are selling one unit of asset and immediately buying it back. So if they are buying it back at a much lesser price, but they have to sell it back at a higher price, that is what is the amount of loss that they are getting incurred, and that is what we are calling as a bid-ask spread. If the bid-ask spread is much higher, it's an indication of high liquidity risk being present in the system. Similarly, market depth. So how many units I can buy or sell at the same current price without changing the price, because after a certain point, after selling some number of units, the price may fall. After buying some number of units, the price may go up. So what we are saying of here as a part of market depth is how many units I can buy or sell without significantly affecting the price. That is what we are calling as the market depth. That plays an important role in determining the market liquidity, and also the market resiliency, which is telling how long will it take the prices that have fallen, whatever is the price that has fallen, how long is it taking for that price to come back. If it comes back much faster, then there is a high amount of market liquidity, but if it is taking significantly longer amount of time to come back to the equilibrium, then it means that the liquidity is at stake, and there is a market liquidity specific risk in the market. So the large price swings occur when more number of traders either exit at same time. Right? One single trader may not be able to influence the price that drastically, but when more number of traders exit the identical position at the same point in time, that is when we talk about large price swings occurring. So that could be a very good measure of assessing the market liquidity. We all know that evaporation of liquidity could lead to a financial crisis. Now if you see here, so let's say initial losses are there on any of the asset. This is what we are calling as a loss spiral. So we are talking about leveraged investors who have borrowed the securities Using that, they are doing a trading. So if, let's say, a simple thing, I have borrowed the money to the extent of, let's say, 90 or 95% from the broker, and I have invested remaining 10% of my money, and based on that I have invested in various securities. Now the value of that asset has fallen, which means the investors, this 10% of the investors' equity is getting eroded altogether. So there is a problem. Now I have to raise funds. Now I'll have a funding problem also, because I don't have the assets to keep as the collateral. Now during this time, my position is getting reduced, because the broker is liquidating my position to recover whatever he has lent to me. And at this stage, even the potential buyers, they don't want to look at buying it, because they want the overall spiral to be exhausted before they re-enter into the market. And there could also be a possibility of predatory trading during this process, because some people, they really want my position to be liquidated at much lesser prices, so that they can take advantage of it by buying it at much throwaway kind of price. So all those things will result in my position getting reduced quite drastically, and because of which the prices fall quite drastically than expected, and this in turn results in a big losses on the existing positions. And now that I have funding problems, even if I have to raise capital, there is a possibility of higher margins being higher. Even if I am borrowing, the margin that would be set, or the haircut that would be set, would be much higher, and that itself will even further increase my funding problem. So now you could see that it's a big spiral, and the whole liquidity gets bursted quite drastically because of this. So there is a kind of a twofold impact on the overall liquidity, leading to a full-fledged financial crisis. And why is this? We see the high increase in the counterparty credit risk came into picture during this liquidity crisis. And one point that I want to stress again and again is, in this process, we see that majority of the financial institutions, they are, for some transactions, they are acting as a lenders, and for some transactions, they are the borrowers, which means you see the same party on either side, both on the lending as well as the borrowing side. So if there is an increase in the counterparty credit risk, if one of the parties is going to default, so the funding needs are typically going up. I need to raise capital. But again, if I have to raise capital, I have to approach another bank. Even that bank would be in the same financial problem, because there is a kind of a chain reaction that came up because of the default. So there is a possibility of a potential systemic risk because of this chain reaction. And all the contracts that various banks and financial institutions have entered into, they are aware of their own contractual arrangement, but they don't know of the entire system, entire situation. So they became more and more worried about their counterparty credit risk. And because of that, a chain reaction, one firm defaulting had a ripple effect on all the other firms, which has finally led to a systemic collapse. This whole counterparty credit risk could have been eliminated or avoided to a large extent because of central counterparties or clearing houses, which knows all the parties who are involved as a part of the transaction. And this is what has come out after the crisis has broken out. But if the same thing would have been planned before the crisis, to a large extent, this kind of liquidity crunch could have been automatically avoided. So this is what I wanted to talk about from this article. I hope you got a good amount of understanding of this article and the various aspects covered as a part of this. If you have any further queries, you can very well get in touch with me by giving me a call on the number that I have given below. or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.